What's up, guys? It's Adam Balsinger coming back at you today with another episode of the Investor Boardroom. Today, I'm going to be talking a little bit about markets and market selection and what we look for when we are choosing a market or not choosing a market to invest in. But before we jump into all that, guys, do us a solid. Like today's video if you get value from it. Share today's video with somebody that you think may benefit from the subject. And of course, subscribe to the channel so that you don't miss out on any future videos that we have. Our goal here is to make you a better investor, a better real estate investor, and to help you get one step closer to that ultimate goal of financial freedom. So, market selection. So, one of the reasons that I am such a huge believer and advocate in multifamily real estate syndication is that we are able to realize appreciation in two ways, okay? Through forced appreciation. What most people don't realize is that commercial real estate is not evaluated the same way as residential real estate. So most of us have bought a house, or we've seen enough house flipping shows on television, right, to know that single family real estate is evaluated based off of comparable sales. Other houses in the neighborhood, similar square footage, similar bedrooms, bathrooms, sold for X, so your property is going to sell for X too, right? It's not the way that it works with commercial real estate. Commercial real estate is actually a business. So when we buy an apartment complex, we're buying a business. Businesses are not evaluated on comps. They're evaluated based off of the income that the business generates. So all commercial multifamily apartments are evaluated based off of net operating income. And by the way that I run the property, if I can force the property to create more income, I can force the value of the property higher. Okay, this is known as forced appreciation. By either raising the income or reducing the expenses, I can make my property worth more money. It's pretty cool. It gives me a little bit more control over the value of the property than a single family fix and flip, right? But markets also appreciate or depreciate in value. So when we are looking at a deal, we want to double dip. I want my toe in the forced appreciation pool and also in the market appreciation pool, right? We wrote an article, again, on forced appreciation recently. You can find that in the blog section of our website, investorboardroom.com/blogs. But in terms of market appreciation, we are always looking to be active in emerging real estate markets. So there's a lot of research that we're going to do before we decide to invest in a market. But two really, really important things that we're looking for, just as kind of an initial sniff test before we decide to invest in a market, we are looking for an area that is experiencing job growth. Okay, so we want to know that the current employers are starting to expand their operations in that area, or that new employers are coming into the area and creating jobs. Okay, jobs, it all starts in our mind with jobs. If there's no employment opportunities there, gradually everybody's going to leave the area. There's a ton of employment opportunities there. Gradually, people start to migrate into these areas, and that leads us to the second big thing that we're looking for is we are looking for household growth. I'm not so much concerned about population growth as I am household growth. Population growth could still be people living under the same roof, and I'm interested in the growth of households there. It's more households that will help to fill units of ours, not one extra baby, right, that's being born. So, two initial things that we're looking for are the job growth and then the household growth. Beyond that, we're looking for stable economies, okay? I do not want to be invested in Detroit in 08, 09, 2010 everything in Detroit, I lived there for a short period of time, literally everything in Detroit relied on the automotive industry. So we're not looking to be exposed to that kind of risk in a market. We like markets that are supported by multiple industries, because if one industry is going through a downturn, typically the entire, like every industry at the same time doesn't go through a downturn. Usually there's, some are going well, others are in a downturn, what have you. So we want to be spread out across different industries so that when and if there are some industries doing well and others not so much, it doesn't hurt our market too significantly, right? So we like being in cities that have, just for example, Charlotte. We're invested in Charlotte. Charlotte has a growing healthcare and education scene. It's got a growing technology scene. The finance that's involved in the city of Charlotte is insane. It's actually the second largest banking city in the entire country. There's a lot of supply chain and logistics that take place in Charlotte. Charlotte's got a decent amount of government here as well. So there's a lot of different industries that will help support and buoy the overall value of Charlotte, even in the case of a downturn. There are some other more detailed figures that we're looking at in terms of household income. We're looking at, cost of housing in these markets, et cetera, et cetera. But those are some of the three biggest things that we're looking for before we really dig into the nitty gritty, so to speak, in a market. We want to make sure that there's job growth, there's household growth, and that it is a stable economy that is supported by multiple industries. When we find those things, we feel comfortable spending time pulling back the curtain, doing a little bit more research in that market. But as I mentioned, we're always looking for assets that we can force the value through forced appreciation, but then also ride that market appreciation as well. Ultimately winds up being much better off for our investors and for our team as well. I hope that you found this value to be insightful and valuable. Again, go ahead and hit that like button. Don't forget to subscribe, and we hope that after today you are one step closer to your own financial freedom.